Good morning, everybody. My name is Brandon Faulkner. I'm an intern with Village Core. Today, I'm joined by Amal, who is going to go over sort of kind of the long-term care of seniors and how to financially plan for everything relating to that. Be sure to check us out on villagecore.org, also on YouTube for meetings like this and events like this to talk about different tech topics. So Amal, thank you so much for being here with me today.
Oh, of course, you're welcome.
And so I'd like to just kind of jump in and talk about kind of what got you interested in this field.
Oh, okay. Well, I actually was right out of college. I went into teaching. I was teaching high school students in low income, impoverished areas in St. Louis. And after teaching for a couple years, I realized that the issue that a lot of these kids were having was actually financial. And right after my contract was over, I interned for Edward Jones, and through interning with Edward Jones and working with a financial advisor, I realized that I had more of an impact teaching adults about finance versus teaching children in the high school environment. So I made a career change in my early 20s, and I've been an advisor ever since.
Very interesting. And
Mm-hmm.
kind of dealing with all this financial planning, is it interesting to see kind of how everything works with different people and different backgrounds of people?
Yes, actually, I think a lot of advisors don't realize that people didn't get to their current financial situations in their lifetime. It's really about generations prior and what happened with laws, right? Wealth wasn't built overnight. A lot of wealth is actually inherited from generation to generation. And so when we look at even housing, education, and that part of the reform, individuals were not allowed to build wealth. They were not allowed to get education, which has led to certain people having an advantage financially than they do now. So I do take pride in educating those minorities who wouldn't have been able to access someone like myself otherwise, because I understand that they are just a product of their environment and the situations that they come from.
And do you think it's important for these families to plan their life ahead of time before anything gets messy?
Yeah, certainly. Most people, even those that have advantages financially, think that they need to wait until the event happens. So, for example, individuals don't plan for retirement until they get into like their 50s, when really the impact is greater if you start planning earlier in life. Because a lot of the time is about the time spent planning and the time being in the market than just planning overall. So the sooner an individual starts planning for any goals that they have, the more likely that goal is to be achieved.
Yeah. And do you think with like um the elderly and kind of retirement planning, as you said, do you think that it's important to realize that they might not have the resources and to actually have people there to reach out and give them those resources to plan their futures?
Yeah, the current generation of baby boomers are um, currently retiring, and they come from parents whose life wasn't as long as theirs, right? Longevity has been increasing every generation, given research, scientific, and just quality of life. People are living longer. And they also are now planning for their own retirements, right? Pensions have been sunsetted. Individuals have 401ks now. And it's just a different way to plan than their parents. So they're really shocked when they are having to now pay for their parents' long-term care or having to plan for their own long-term care, because that's not something that generations did prior, right? Most people life expectancy, just 2 generations ago were in their 70s, right? So when they retired, they only really needed to plan for 10 years. Now individuals, especially women, have retirement as long as 25 to 30 years. So a big portion of that is going to be spent in a nursing facility or even in a skilled facility if it comes to, dementia or Alzheimer's, or other things like that.
And are there kind of certain health conditions that can increase a financial plan or a premium that kind of impact people the most?
Yeah, that's actually a really good question. Most people, when I ask about their financial plan, will say, "Well, I have children who will take care of me," or um, "I'll self-insure." And what individuals don't realize is that we can only plan for worst case scenario. We don't really know what their life expectancy is or how much money they're actually going to need. So if someone has a history of um, cognitive impairments in their family, like dementia, Alzheimer's, Parkinson's. Those are things that actually prolong life, but that doesn't really cause mortality. So individuals that are in those situations are going to need to plan for having a skilled facility accessible to them and being able to afford them, because that's prolonged period of time. And if someone is going to self-insure, that's going to get really expensive because you don't really know how long you're going to be in these facilities. And on the other end of the spectrum, individuals who have plans like my children are going to take care of me, and that's all good, but children are also working for their own goals. And so when you put that burden on your children, that is an opportunity cost that your children are missing out on. They're not working during that time if they're taking care of you. So how will they pay for their own expenses? Um, and most people, I think, don't like to think about it because it's kind of scary. It's stressful to think about what they're going to do, whether or not they're going to be able to afford it. So they just don't think about it. And then they're put in a situation where they may have to rely on their assets, depleting them, or the government, which is not necessarily a good situation.
And do you think that family history impacts the rate of a financial plan?
Like specifically with long-term care or
Like
just financial
long-term care,
planning?
or like kind of like the financial history of your family or the medical history of your family? Does that kind of like impact how your rate might look?
Um, in terms of cost, probably not. I mean, they do ask for family health history and underwriting, but it's really about how healthy you are today. From an insurance perspective, what they're really looking at is the risk to insure you. So if you're a higher risk, your premium is going to match that risk. So if you have been injured or have seen an orthopedic doctor quite a bit, or have a medical history of things that may cause physical ailments, then that's going to increase your long-term care premium, which is different than someone's life insurance premium, which is based on mortality, right? We're looking at mortality rates, which is set by the census. And every, I think, 3 to 4 years, they look at mortality rates and how they've been increasing. And life insurance bases their price based on those mortality rates. And then the long-term care side, those prices and premiums are set by morbidity. How well can you take care of yourself? If you've been injured, if you broke a knee or an ankle, that may cause you to need help as you age and your bones aren't as strong anymore.
Yeah. And I kind of wanted to ask you, what is a cash value of life insurance and how can it be used?
Yes, so uh, there are different type of advisors, that plan to utilize life insurance as more than just life insurance. A lot of those advisors may not be licensed to sell securities, and so they utilize life insurance where it doesn't require securities to plan for retirement. Um, it can be argued both ways. Essentially, what individuals do is they create a life insurance policy with the idea of overfunding it. And by overfunding it, that means that you're paying more than the minimum premium for that death benefit. So every portion of the premium that you pay that is above the minimum premium is then put into this cash value. Depending on the type of policy, that cash value will either increase based on dividends or based on returns in the market. Um, And so the whole idea of overfunding a cash value is that later down the line, you could borrow against your cash value, which creates what they call, or what individuals may call, tax-free income. Because when you borrow, that's not taxable money. That when you borrow the cash value, then you could create a stream of income for yourself that's tax-free. But sometimes, depending on the design of the policy, that may take away from the death benefit. So you have to be really careful when you try to utilize life insurance as a retirement plan, because at the end of the day, it's still under the umbrella of life insurance.
And do you think that more and more people are getting kind of nervous about planning their futures out ahead because they don't want to talk about that topic like so soon in their lives because they think, oh, I have enough time left. That won't happen to me yet.
Yeah, what I've seen actually is that if their parents had a financial advisor, or if their parents had a financial plan, they're more likely to start earlier in their financial planning versus individuals who have not had or any personal finance education within the household. Those individuals, I think, are more likely to put it off. Sometimes people feel like they can't afford a financial advisor because they feel like you may need a certain net worth or a certain amount of money to have a financial advisor, which is inaccurate. I think that financial advisors do work with individuals who have goals, um, and can help plan for anyone, regardless of how much money you have.
Yeah. And what is the difference between term life and whole life?
Yes, so term life and whole life are two types of life insurance. So when you want to think of life insurance, there are two main buckets or umbrellas. There is the term insurance, which is very simple. It works just like car insurance, right? So if you have a policy that's active and you file a claim within that active period, the insurance company will pay that death benefit, but that is essentially it, right? After that term is over, typically on an individual side, that's 30 years maximum. Once that term is over, you don't really get anything from it, right? So on the insurance company side, they understand that the likelihood of you outliving your term policy is pretty high. Therefore, the premiums are going to be pretty low. So if you're in a budget, term policy makes sense because you're insuring you higher earning years at a low cost. Group insurance is also works just like term insurance. You only insured while you're employed, and then when you separate, you don't have that insurance. Now, on the permanent side, it gets a bit more complex because there's multiple designs, right? We talked about dividend paying insurance policies, which is like whole life. And then on the other end, there's insurance policies that have exposure to the market. So an index policy or a variable policy will have their cash value grow based on the market. It all depends on how the individual is comfortable with risk. If they're very risk averse, they may want to opt in for a whole life policy because that is the most guarantees that you may have. But when you purchase guarantees, you also are purchasing that at a premium. So whole life is going to be naturally the most expensive type of policy you could purchase. Then there's your indexed policies where you choose an index like an S&P 500 and you follow that index, but they may offer you some floors and some caps. As much as insurance is good, it is still a business, and an insurance company is going to do what they need to do to make money. So when they offer you a guarantee or a floor, they're going to make sure that they're gaining on the other side. So they'll put a cap on there, and they know how the market works, so they'll be able to pocket all of those profits, but it gives you peace of mind at the end of the day. So yeah, the design is more complicated on the permanent side, but just like it sounds, it's really insurance for a lifetime, right? It doesn't matter if you pass away in a year or in 45 years, that permanent policy will always be around.
Very interesting. Yeah.
Mhm.
And what is a rider for long-term care?
So a rider is essentially a feature that you could add onto a policy, and you pay for. So you could add a long-term care or a chronic illness rider on a life insurance policy, Or if you have a standalone long-term care policy, you could add a rider, like a spousal rider. You could say, well, if I don't ever use my benefits, have those benefits be, you know, given to my spouse if I pass away. So a rider is just an additional benefit that you could pay for, that would allow you to kind of design the policy however you want. So individuals now, the way that long-term care was designed when it first came out was that insurance companies would cover for as long as you needed it. But they realized that people were living really long, and now they had to increase their premiums in order to still have those individuals be covered. So what they've done is they've created ways for individuals to add riders to existing life insurance policies or any new policies. So they'll add a rider to a policy allowing you to access your death benefit for long-term care purposes. But what you've done now is if your long-term care, I mean, if your life insurance policy was your estate and legacy plan, you know, leaving that to your children, if you now utilize it for long-term care, you no longer have that plan. So it's a good way to have a hybrid and be able to maximize your premiums to accomplish multiple goals. But um, not often can you actually maximize both goals, right? It's just either a portion will go to your children, a portion to long-term care, or 100% to your children, or vice versa.
And do you think that it's important for younger generations to understand about this insurance to plan for not only their futures, but also to plan for their kids' futures and also their parents' futures later on in their lives?
Yeah, I think that if you look at millennials, um, we're probably going to be one of the first generations where we might have to help our parents pay for long-term care, and then also have to plan for our own long-term care more than baby boomers, because the longevity of our millennials grandparents was a lot shorter. And now we know that baby boomers are probably going to live longer than the previous generation. So I think millennials really have to be considering how much it's going to cost for them to retire, how much it's going to cost to help their parents go into these facilities, and then also how are they going to plan for their own long-term care, and what that looks like. I think as generations go, that's going to get more and more important. So we've been doing, as financial advisors, multi-generational planning more than we've ever.
And are there any health exams for any premiums? And kind of, if there are, what does that involve?
Yes, so there is long-term care policies that are what we call just like your original long-term care policies. It's not a life insurance. Those underwritings are going to be more difficult because the insurance company is going to have to pay an income out to the insured for what could be 3 years, 5 years, 8 years. So they're going to do a pretty extensive underwriting. Really, they'll pull medical records, they'll see how long, what their parents died from. I'm not too familiar with underwriting, but it is pretty extensive. You're more likely to get approved for life insurance with a long-term care rider or a chronic illness rider, because the life insurance is going to be underwritten for mortality, and then they'll do a shorter underwriting for that long-term care portion of it. So if you're afraid, I mean, if I, as an advisor, was unsure about what my client would be approved for, then I may decide to do a life insurance policy versus a long-term care policy.
And do you yourself have like any kind of tips for people trying to figure out kind of what steps to take next in their plans for figuring out their life later down the road?
Yes, well, I think that speaking to a professional, it's always going to be better. I think sometimes people think that because of the amount of information that you could find online, that they could do their research themselves and figure it out on their own. But if I, as an advisor, am doing this day in, day out, I understand the products, I understand how planning works. I'm immediately going to have more knowledge than someone who's gone on Google and done some research. It's almost like if I were to go to a doctor and, say, I found this online, this is what I think I have. But, the doctor has gone to medical school, they've done residencies. So if I'm going to go see an expert about my health issues, I'm going to trust an expert to do that part. Just like, I may be in finance, but I don't do my own taxes, right? Because I know there's an expert there that's going to maximize my tax planning and allow me to focus on the things that I'm good at. So I would say if anyone wants to get started, to speak to an advisor. They're the ones who are going to be able to help with the planning portion of it.
Very interesting. We have just enough time here for questioning. So if anybody watching wants to ask any questions, feel free.
Hi, Amal. This was so informative. I so appreciate you being here today.
Of course.
Could you walk us through what kind of benefits can one expect if they have a long-term care policy? Are they generally enough to cover for the entire amount someone might need if they end up in memory care? What other supplemental income should they be thinking of? Just kind of benefits you get with long-term care. Could you expand on that?
Yes. So if you're looking at let me take a step back. So when I review products with clients, I talk about what goals they have and the family history. So if I know that one of their parents has had Alzheimer's, for example, then the likelihood of me proposing a life insurance with a chronic illness rider is slimmer, because with a long-term care policy, we could build unlimited type of policies. So that means that it doesn't matter how long the person is in this care facility, they're going to have coverage. When you look at a long life insurance policy with that rider on there, the amount of benefit you have is equal to the death benefit you have. So when you take 2% of that death benefit and you're maxing it out at 2%, that's going to last you a total of 50 months, 50. So it's a little over 4 years. And when it comes to memory facilities, typically the average stay time is around 7 to 8 years. So there may be a portion of that they may need to self-insure. And that is a conversation that I end up having with my clients, because some people will take a gamble and say, well, if I'm living much longer than that, then I don't mind if the government pays for it. Or if I'm living longer than that, then I won't be doing anything else. I'll insure myself. Or individuals don't have that kind of history, and so 5 years is enough time. If you don't have a memory issue, then the average stay in a long-term care facility is about 3 to 4 years. And that's because most people will stay at home for as long as they can before going into that facility. So planning with a life insurance makes sense for them, because we know that the likelihood that they'll need 8 years is pretty slim. So, and that's what I was talking about, speaking to an advisor. You wouldn't, as an individual doing research, you wouldn't know to look for a long-term care policy versus a life insurance, or that family history may play a part in the decision or the product that you end up choosing. So it's a conversation. It's a planning between the financial advisor and the clients.
Interesting. And is there anybody else who has questions?
Well, I have one more. What age is too early to be planning this?
I would say the ideal age to plan is probably in your early 50s to late 50s. Too early, the earlier, probably the better. But most people are not thinking long-term care between their 30s and 40s. And the reason why I say earlier is better is because with any type of insurance, the two things that we look at is health and age. And so technically, the youngest and healthiest you'll be is today. So when we're looking at pricing, it makes more sense to look earlier versus later. But when we're looking at an overall picture, where does it make more sense to put limited amount of funds right now? And mostly people will pick retirement because that's the first thing on their mind. So usually do retirement planning or education planning. And then once everything is set, we'll probably start conversations about what long-term care or what things derail plans. We may throw some scenarios in there. What if there's an unexpected death? What if one partner passes away earlier than expected? And so I wouldn't say there's an age. It's typically time with an advisor. The longer I've had a client, the more likely I'm able to have these long-term care discussions because I know other parts of their plan are already planned for.
Okay.
All right.
All right. Well, I
So,
hope you all found it helpful.
oh yeah, I found it very informative.
It was
Okay.
very, very helpful. I've been trying to
Okay.
get some information, and you opened my eyes to a lot more just in this discussion.
Well, good. Yeah. Well, if any other questions come up, definitely reach out to me. I'm part of a team, and being part of a team allows me to focus on the protection part of a plan. So my partner does all of the investments, and that way, when we bring both pieces together, I have more education on protection. She has more education on the growth, and then together we have a better plan than if I were to try to get knowledge on all of it myself.
All right. Well, thank you so much for being here
Of
today
course.
and letting me
Of
talk to
course,
you.
I enjoyed. I enjoyed it. I love education. I mean, that's why I went to school for education. But now I'm just educating people about other things, which is also very good.
Yes. And once again, we hold other meetings like this for anybody out
Hmm.
there. So be sure to check out villagecore.org along with the YouTube channel if you miss any meetings like this where I talk about different ranges of topics, usually tech, or I interview people like this to get more information about what may be happening with your life or how to plan it out, just like this. So thank you so much, Amal, for doing this today.
No problem. You all have a good day.
You too.
Bye.